Hey, good morning, everyone. Marty Mazzora here, June 28th, 2026, with some video commentary for you. We're going to look at the stock market via the S&P 500 and the NASDAQ 100 indexes. I want to look at yields. I want to look at the dollar. I want to look at gold and oil and inflation break-evens and energy inventories and maybe a couple of other things. I'm going to try not to keep you too long. It's been a while since I've done a video. I mentioned on the written blog, I think yesterday or the one Friday, that the technicals are beginning to look interesting, or they always look interesting to me, but enough so that I thought that it would be time to offer up a video, which we don't do nearly as frequently, or we haven't of late, simply because, as I said, the narrative-driven market that we're experiencing, the headline-driven, the social media post-driven market, if you will, lends itself to technical setups that can be blown to smithereens in a couple minutes. And you know what I mean. There's just a lot going on in the world right now, so it seems more, I think, prudent or more important to talk about those things and market dynamics, keeping our eye on the fundamentals and our longer-term thesis. But clients, as you've noticed, we've had to be very active this year, or tactical, both in a defensive manner and in an opportunistic manner. And I don't see why any of that would change anytime soon based on what's going on. So having said that, if that makes sense or not, here is a chart in front of you of the daily 1 year, or it's a daily 1 year look at the S&P 500. Each candle that you see, blue or white, is a day. The blue is a down day. The white is an up day. And as you can see, we are coming off of all-time highs. We peaked right here and have begun to retrace some of that peak at the 24% retracement level. You see we're finding some support right there. Technical problem is that on Friday we broke down below the 50-day moving average. And if that were to continue, I would say there's some support right here, a little bit lower at the 38.2% retracement. And then you get a lot of support down here below 7,000 on the S&P, right at the 50% retracement and just above the 200-day moving average. I would expect, barring anything newsworthy or news-wise that would cause this to really careen below that, I would suspect some serious support right in there if indeed we get there. Traders should be buying that level if indeed we get down that low. As for the momentum, the underlying momentum, it pretty much called this. We were rolling over on the moving average convergence divergence as we were hitting that all-time high. That suggested odds favoring that it would not stick. Same thing on an overbought reading of the relative strength index. Right now, this kind of just confirms where we are. It doesn't give you any bullish or bearish divergence. Again, the technical potential problem here is that it closed below the 50-day moving average. False breakdowns happen all the time, just like false breakouts. So I think it all depends on the weekend news. And as you may know, the weekend news shows that there is a resumption of kinetic activity in the Middle East. We'll see how that treats markets come tomorrow morning. Oil prices in the weekend markets are up about 2% as I speak to you. As for the NASDAQ 100 index, it's actually a worse looking chart. That's been showing up in the action in the tech sector, and we'll talk about sectors here at the end as well. The NASDAQ 100, I have an extra moving average on here. It's the 20-day because it seems to be a very important line for support and resistance, and you can see how it just kind of dances along that. Then it breaks out with some momentum, found some support here after a false breakdown, at least it looked like that, came back, challenged this all-time high and failed it miserably with a big gap right here. The gap still is yet to fill. It ultimately will, I'm certain. Right now, it's sitting right on top of the 50-day moving average. Now, it closed above the 50-day, which is positive, and right at that 24% retracement. Looking at the technicals, absolutely, this looked like it was going to roll over. You can see we had this second high here against falling momentum, and here we are. And again, this looks virtually the same as the S&P 500. So we could get into different time frames, shorter and longer, but I've got a lot to talk about today, so we'll just keep it at the one-year daily charts. These are somewhat ambiguous right here. Again, coming back and failing at that high is a really bad sign. Breaking below the 20-day moving average is a bad sign short term, but finding support at the 50 on Friday is a positive sign, which was not the case, as I just showed you, on the S&P 500. 10-year yields, very interesting. We can see we peaked right here at about 4.7%. Have come off of that. You can see that that peak was met without much support from the momentum. And again, of course, it did roll over. I have a trend line right here that got broke down, then tested, and then failed that trend line. Looking at support at about 4.35% perhaps. I think you could safely say that the 10-year yield is tracking oil prices right now. The idea that the Strait of Hormuz ultimately is inflationary because of higher energy prices. And I'm going to give you a reason for why yields are down, the dollar is up, gold is down, et cetera. And these are different reasons. We're starting to see a little bit of trading divergences in terms of what's moving markets. For example, here yields are going down, but the dollar has been going up, right? And that's not the normal correlation that we necessarily typically see, although things move for different reasons at different times. I preach that to people all the time. So I do think that the dollar is still responding to yields, but it's responding to the prospects for Fed rate increase this year. And we'll look at Fed funds futures odds here in a second. So here you have the 10-year yield declining. You would think the dollar would be declining with it. And here you have the dollar going up. But I think the dollar is probably being bid up as a response to potential interest rate differentials between the U.S. and the rest of the world if the U.S. Fed did start getting aggressive with rate hikes coming up. That's not our base case, by the way, and I'll probably talk about that a little bit as well. So here you have gold that when it's rallied pretty nicely along with equities. Definitely has had a counter correlation to yields. And again, here you have yields dropping and you have gold dropping at around the same time. So again, I think that gold now, where it hasn't been quite as correlated as normal to the dollar of late, looks pretty correlated there, although we did get a nice little pop in here. Trading, again, counter to the dollar and maybe alongside the increase in the odds for Fed funds to go up. Notice I started drawing this trading range. It looked a lot like this one back here in 2025 that we broke out of decidedly, rested back in here. I've been extending this as we go, and it broke out of a new trading range into a new all-time high. Remember, though, I was doing videos up here, folks, and this is where we started hedging our gold position with a put option that has been good to own while this has been happening. We've been rolling it. The other day when we had a big sell-off, the put option doubled in price and basically mitigated, probably 75% of the drop. So that's why we had that. We like gold longer term, but we haven't liked it much, since up in here. And it's down, I think mid-single digits on the year now. Remember, again, back in here when I was showing you, and I showed you decades of when the gold, and this is the gold ETF, so it's a proxy, but when gold gets overbought, and I was showing you that actually on the gold chart, you tend to get double-digit declines. This was mild historically. It was only 11%. This was 21% to about here, but we thought that maybe it wasn't over. Here's that 50-day moving average. You can see it kept trying to burst through there. Technically, that's a bad sign because it kept failing, and then it failed a lot. Here's the 200-day moving average. Didn't even really find much support there at all. Found resistance right about there. And now you have the 50-day crossing the 200-day, and everybody's going to start talking about the death cross, which is what they call that. I am not a big fan of that as a decent or a legitimate indicator, so we don't really give it much weight, but the media seems to. So we'll see if you see a headline or two about the death cross in gold. Right now, finding support at the bottom of that trading range. Longer term, I think gold goes higher. Near term, pretty ambiguous setup. If we're right about the Fed not raising interest rates this year, which is not what the market's discounting, it is discounting a rate hike. But if we're right about that and gold keeps trading this way, well, then gold would catch a bid as we get closer to the acknowledgement that there's no rate hike, if indeed that thesis is the correct one. So oil has dropped quite a bit. We got all the way up to north of 100 on West Texas Intermediate, and now we're down to 69.23. Of course, this is all about the Strait of Hormuz. As I mentioned, it's not showing up here. There's 2% up, so there's about $1.50 increase to be had if this were to open right now. We shall see. You can see we're still well above where we started the year at about $57 a barrel. We're going to talk about inventories here in a second. I actually think this might be an overshoot to the downside. It could go lower. This is what's happening. This is what traders are doing to the price. Could even go lower, but I think it's probably an overshoot. My guess is that we're probably going to settle in somewhere up here in this range, all things equal, and we'll come back. Maybe that'll be resistance around $80 a barrel. But again, the situation in the Middle East has heated back up. Just days after they signed that MOU with the 60-day negotiation period attached to it. So we'll see. We'll see what goes on here this next week. Price of a gallon of gas nationwide, 3.87 cents or $3.87 as I speak. It was up above $4.50. Still, people are paying a ton more than they were at the beginning of the year, a whole $1 per gallon. Consumer sentiment has improved a little bit as gas prices have come down. We'll see, where we go. Again, depends on the Middle East right here. Before we get to inventories, I do want to talk about this. This is the CPI swaps, part of our PWA index, part of the inflation subcomponent. And they're rolling off a cliff right here. It's a compensation for inflation. Some people say it's market expectations, but it's just following the price of crude right here. Definitely not following the odds of a rate increase that the market is pricing in later this year. So again, that was interesting to see, but not sure the market's getting this one right, frankly. Okay, so inventories, U.S. commercial crude stocks across the board versus the 5-year average. And this is where we are right now. It's this orange line. As you can see, inventories are low, as makes sense, versus where they've been on a 5-year average, the high, the low, and the average. So crude stocks are going to need to be rebuilt. Here's the Cushing, Oklahoma. You can see inventories are way down there as well. Gasoline stocks right now are under where the average has been over the last 5 years, but you can see there's been some buildup in gasoline inventories. And distillates, in this case diesel and heating oil, you can see very low inventories, but coming off of those lows. Not the case over here with oil just yet. So what's my point there? Looking at the price of oil and the fact that the inventories have been so drawn. The president said another 4 weeks and we're out of oil right before signing that MOU with Iran. Was obviously he was stating a very serious concern and wanting to get oil flowing again so that this would happen and that more of this would happen with gasoline. Now, again, though, oil inventories are down. The strategic petroleum reserves, I don't have that chart up for the U.S., are down, and those things need to be replenished. And the situation that caused this would obviously inspire the replenishment all the more. And I suspect even in parts of the world where they didn't have strategic reserves will want to have them going forward because they can see how at least 20% of global oil production can be taken offline or not transferred as it normally is. Now, will the powers that be on those strategic petroleum reserves do that, or will they try their best and hold their breath to not spend a lot of money on oil, pushing the price back up between now and maybe midterm elections, if you will? That remains to be seen, but prudence would say they need to buy that oil. And that's oil that's not going into the economy and reducing the price. That's actually demand that would be increasing the price. The Fed interest rate probabilities, this right here says that one rate hike is 100% priced in, and 26% of two rate hikes between now and the end of the year. One rate hike is 25 basis points. We don't really think that's going to happen, not because it shouldn't, and I talked about this on the written blog yesterday. We just think that the ultimate objective, longer term, lends itself to keeping short-term rates low. We have a massive amount of debt that's coming due over the next 2 years. We have a massive budget deficit. The government is spending a lot more than it's taking in, and they're going to have to borrow and borrow and borrow to fund that deficit. I've talked many times about the World War II setup where the Treasury coordinated with the Fed, and the Fed monetized the debt. So the Fed printed money, would buy Treasury bonds to make up the difference that the markets and international buyers were not doing, so that they could keep yields low, so that they could refinance and run those post-war deficits at lower interest rates. So I think that's the game plan, and that's how you get rid of the debt. Basically, if you can keep interest rates somewhat capped and let inflation run hot, nominal GDP grows while the debt hopefully grows slower, and you end up in a few years with less than 100% debt to GDP. It worked like a charm from 1943 to 1952, and we haven't been in a situation like this since then. So I suspect some variety of that strategy will ultimately come, and it's going to require the Fed playing ball with the Treasury. Does it mean we won't get any rate hikes? No, not necessarily. Maybe we will, but right now, longer term, I don't think you're going to see massively higher Fed funds rates. You could, but I don't think so. Now, Kevin Warsh, they say, has a history of being hawkish, someone who could actually do that. I don't see it that way. I believe under the conditions in which he got appointed, suggested that he made different kinds of commitments to the powers that be. You notice he did not make a commitment himself last meeting when all the other ones were getting more hawkish and more concerned about inflation. He is promoting a couple different inflation gauges where you basically take off the highest mark and the lowest mark, but right now it definitely benefits you to take off the highest mark. It's called trimmed mean. And so if he can get the Fed board to buy into that, they're going to start advertising more friendly, or looking at more friendly and talking about more friendly inflation metrics that you and I may not sympathize with when we go to the grocery store, etc. And then lastly, just a 1 month look at the sectors, the major sectors in the U.S. equity market. Financials over the last month, they've been down on the year until recently, are up 4.83%. So we've been fortunate to have anticipated this to some extent, maybe not in this time frame. So financials we've been adding to several times this year, and now they're our largest U.S. sector. So we've been benefiting from that. We also have been adding to our healthcare exposure, and it's up the most over the last month. So we've been benefiting from that. It's basically just allowing us to hold on to pretty nice year-to-date gains. We're definitely off of our earlier peak just a few weeks ago, but we're still hanging in there pretty well. Those things are helping out. Industrials, we have a pretty good allocation there. They're up 4.45%. Tech is down. Tech is still leading the way, I think, year to date, but it's down 5.6%. Consumer discretionary, which unfortunately is a pretty good allocation for us as well, is down 8.3%. So that's where we've taken a hit over the last month. Now, our consumer discretionary, we increased that coming into the year because we knew that consumers were going to get the largest tax refunds they've ever gotten. Unfortunately, it also coincided with something we did not have on our radar, and that was the war in Iran. And so that it obviously has created some consternation. I like it here despite this. So they're cheaper. We're not selling our consumer discretionary position right now in the U.S. Our intent is to hold it right here. If the Strait of Hormuz situation continues and oil continues to flow and the kinetic activity abates once again and animal spirits come back, there could be a really nice run between now and, say, midterms for consumer discretionary. Energy stocks, which are way up on the year, obviously down with oil prices. I mentioned healthcare already. Consumer staples are kind of hanging in there. Communication stocks have taken quite a hit. We do have some of that exposure as well. But interesting how there's been the flip. This is called rotation. The things that were working are rotating out into the things that have not been working. It's not a bad sign, actually, for the health of the overall market. As I continue to say, we remain constructive until we get into the fall. And after that, we're going to lose some of this sanguine feel, and we'll probably have to adjust to a different reality going into 2027. But that's always subject to change based on conditions and the data. And we'll continue to keep you posted. Folks, thank you, as always, for watching and listening. And talk to you again soon. Have a great weekend or a great rest of your weekend. Take care. Bye-bye.